And happy Wednesday, options traders. Welcome back, everyone. A common question that traders have is how do I figure out the rate of return that I need to meet some type of a specific goal? And that's always a good idea is to have some type of a target. So, for example, if you want to double your account in 5 years, what annualized rate of return would you need to accomplish that? And the calculation that most traders use is going to force you to take more risk than is required. So, how do you go about answering this question? Well, that takes a special calculation called a geometric return. It's used all the time in finance. Let's go find out more about it, what it is, and how to calculate it. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, return on investment, again, very common calculation. We can use it before the fact. How much do I need to meet a certain goal? Or maybe after the fact. I've been investing for 5 years. What rate of return did I accomplish? Well, let's step through the basics and then we'll look at some examples. So let's say that you wish to double your account in 5 years. In other words, you want 100% on your money. It's a twofold on your money, but it's 100%. And the mistake that people make is they'll say, well, 100% divided by 5 years is 20% per year. That's an arithmetic calculation and it doesn't account for compounding. And that's the problem. If you try to shoot for 20% per year, you're going to take on far more risk than you actually need. Because let's say for any given amount that you have invested, pick a number, you've got $10,000 in your account. How would you figure it out at 20% per year? What would you end up with? Well, you could take the long route and say we're going to take your 10,000 bucks, multiply it by 1.2. That's an increase of 20% on your money. And that's going to be $12,000. We're going to take that number, multiply it by 1.2, multiply that by 1.2, multiply that by 1.2, and then finally multiply it again by 1.2. Because that would be 5 years multiplying by 1.2. Now, the shortcut way is to take 1.2 and raise it to the number of years. So you can just take a calculator, take 1.2 and raise it to, in this example, 5, and you're going to get 2.49. Now, this is going to tell you the multiplier. You have 2.49 times your money, but to convert it to a percent, we have to subtract off 1. So 2.49 minus 1 is 1.49, and that would be 149%. So you can see if your goal is to double it or 100%, you have overshot it by a long ways. You're trying to take enough risk to generate 149% per year. So before we go any further, let's take a look at how to do this calculation right here. You can do it on pretty much any basic calculator. You can certainly use it on a desktop calculator. So for example, let's just take 1.2. I'm going to hit this key, that little x raised to the y. That's saying take some number raised to some other number. So I'm going to click on that, and I'm going to raise it to this 5 right here. Click there, click equals, and there you can see it's about 2.49. That's what we came up with here. We subtract off 1 equals a multiple of 1.48, and then we just convert that to a percentage, just multiply by 100. So that would be about 149%. But once again, if you're only trying to shoot, I say only, that's still a very healthy return for a 5-year period. Not undoable, but still a pretty hefty goal. But you can see that if that's what you're trying to do, that you're really going to be shooting more for 149%. So the question is, if we don't need 20% per year, how do you calculate the ROI to make it so that you would double your money in 5 years? Well, again, that's where the geometric return comes in, and this is going to account for compounding. So the geometric return, pretty simple. You're going to start with the multiplier. So in that previous example, your multiplier is 2. You're trying to double your account. And you're going to take that number and raise it to 1 divided by the number of years. And then as we saw, you would subtract off 1 and then convert it to a percent. So, what rate of return do you need if you want to double your account in 5 years? Here's the way you do it. Remember, your multiplier is 2, number of years is 5. Take 2 raised to the 1 divided by 5, or to the 1/5 power, equals 1.148. We subtract off 1, and that gives us 14.8% per year. So that would really be your target, 14.8% per year, to double your account in 5 years. Now, don't get me wrong, that's still a pretty healthy return, but it's not 20% per year. You can see that's significantly lower. So if you were trying to earn at the rate of 20% in order to double your account in 5 years, you're taking far more risk than you need. Your target should be at 14.8, let's just call it 15% per year. Now we can check this by working the math backwards. So we take the answer that we came up with, multiplier of 1.148, raise it to the 5th power, and that equals 2. So that's just telling you if you multiply your money by 1.148 times, but do that 5 times, you're going to end up doubling your money. So this whole idea of a geometric return can take a little bit of examples and work to get used to it, but it's actually quite simple. Let's run through a few examples. Let's say that you want to triple your account in 10 years. Well, what's your multiplier? It's 3. You're trying to triple your account. Now remember, that would be a 200% increase. But for this, we want to know the multiplier. So the multiplier is 3. What's the number of years? Is 10. So now we're just going to take 3 raised to the 1 divided by 10. We're going to take 3, what's actually called to the 1/10 power, or for all the math people would be the 10th root. So we take 3 raised to the 1/10 equals 1.116. We take this number, we subtract off 1, convert it to a percent, and it would be about 11.6% per year. So if you generated 11.6 per year, every year without fail for 10 years, you would triple your account. Let's look at example number 2. Let's say that you want to increase your account by 50% in 6 years. Well, now your multiplier is 1.5. Yes, it's 50%, but you're trying to multiply your money by 1.5 times. So if you have $100 and you multiply it by 1.5, that's $150. So you don't want to get messed up in the calculation and say, I'm trying to multiply it by 50%. You're not. You're trying to multiply your money out by 1.5. The number of years is 6. So we take 1.5 raised to the 1 divided by 6, comes up to 1.0699. We subtract off 1. That's going to give us 6.99%, but we can certainly call that 7% per year. So if you generate 7% per year for 6 years, you will increase your account by 50%. Now we can also work this calculation in reverse, kind of after the fact. So let's say that you have $10,000 today, and at the end of the first year you have $11,000, end of the second year it's grown to $13,000, and at the end of the third it's up to $17,000. Now, where a lot of traders make their mistakes is they'll say, well, I've been investing for 4 years. So this has been for 4 years. Well, no. The first year was from here to here, and then going from 11,000 to 13,000 was the second year, and then from 13,000 to 17,000 was the third year. So it's been invested for 3 years. Now, what's the multiplier there? Well, you should be able to figure out going from 10,000 to 17,000 is 1.7, but you can just divide the ending balance by the beginning balance. So 17,000 divided by 10,000 is 1.7. We have increased our money by a factor of 1.7 over 3 years. So the number of years is 3. We take 1.7 raised to the 1 divided by 3 equals 1.1935. We subtract off 1. We get 0.1935, which of course is 19.35% per year. So this is telling you that over this time frame here, on average, you generated 19 point almost 4% per per year. And if you want to check your work, right, all formulas work forwards and backwards. We could take 1.1935 and raise it to the number of years, and we get 1.7, which is in fact the multiple on our money. So again, it's just a handy calculation. So if you're trying to set goals and targets, how much do I need per year? Or is this a good time to hedge, roll, or morph because I'm ahead of schedule or ahead of target? These are the calculations you need to know, and hopefully they make more sense. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.